Welcome to Trading Day Your Call on Your Money.
A very good afternoon to you. Welcome to this Tuesday's Trading Day Your Call. I'm Fauzia Ibrahim. For the next 2 hours, we are taking your market queries. Now, if you don't remember that number, it's 1300 30 34 35. You can also email us, yourcall@yourmoney.com.au. Before we get to your queries, though, let's take a look at how the markets are doing at the moment. As we see, there's no escaping the sea of red on the local markets there. We've got the technology, financial sectors taking the biggest hits today. Of course, we are tracking the losses off Wall Street. This is, of course, after the tensions. Investors very nervous over the China's-US trade tensions that's currently ongoing at the moment. It is Main Pharma that is taking the biggest cut today, down almost 15% as it warns that sales of its generic drugs have fallen by 1/3%. Also making news this hour, as I mentioned before, the trade wars between China and the US ramping up even further. Now China has confirmed that it will hit US imports with tit-for-tat tariffs. And as a result, the yuan plunging as US tariffs start to weigh in on the global economy. Let's meet our panel today. Joining me on this Tuesday afternoon, we've got Elio D'Amato from Lincoln Indicators. We also have David Novac from Wealthwise Education. Thank you so much, gentlemen, for coming in and chatting with us. This trade war, it is ongoing. Just when we thought, all right, we're about to see a resolution here, one tweet decides to change everything else, and it's just triggered a chain of events. You know, now we see China increasing its own tariffs over on US goods as well. The question here is, with all this volatility, and of course we're seeing it being played out on the markets, where is the safe haven? Where do you park your money? Where would you?
Well, look, the greatest insurance any investor can have is in cash, really. And, you know, when there's periods of volatility, it's often one of those realms of safety that we tend to flood to, particularly when there's nowhere else better to park it or there's nowhere with any conviction that you can put it. Now, obviously, we're not fans of leaving it in there forever, but cash can be used as a very effective portfolio management tool, particularly during bull markets, whereby you can actually use it to create your war chest in order to seize on future opportunities when volatile periods such as now occur. Although I think it's important to keep it in perspective, notwithstanding the red on screen today and a few of those nerves and the like. It is only one day in a real whole scheme of things, so we're not seeing a big pullback yet. It doesn't mean it can't eventuate into something else, but you know, all we just caution investors to do is to ensure that you're not panicking at this particular point in time. There's no immediate need to change your investment strategy. By all means, get yourself realigned, take some profits off the table if you've made some very good gains, but don't do anything silly and go against your tried and true investment strategy at this point, because trading by headlines is not a successful long-term investing solution. Because, you know, as we saw yesterday with that big swing in the US, what turned from negative to positive, I mean, you know, trading on headlines, you'll just go broke in our opinion.
Absolutely, but of course, you know, in this sea of red, you must be seeing some sort of opportunity as well. This is some way to get in.
Oh, there's always opportunities.
Always opportunities.
There's always opportunities. And for option traders like myself, we love volatility, and I've got to say it's been a little bit quiet, and so it's not surprising. I've got to say there's no surprise at all, this move, and the only surprise was how the US market closed up on Friday. You know, that was a big surprise. So look, this retaliation from China, you had to expect it, really. But look, volatility is a good thing and opportunities abound, you know, so there's a corrective sell-off here. I don't think it's going to be that deep, to tell you the truth, because both parties can't afford, they just can't afford to play this kind of chicken and you know, cat game sort of thing, you know. So we'll see. I think we will see a resolution. It's a bit further down the track, and you know, for Trump's political career as well. So you know, there's a bit of cat and mouse going on here.
Absolutely. You know, Australia's always seen, the Aussie dollar in particular, is always seen as the proxy for China's trade. And do you think perhaps with both economies sort of at this tariff war with each other, Australia might be seen as the safe haven? We could actually benefit from this, do you think?
Well, I think on the commodities complex of the weaker dollar, obviously there's opportunities. Agriculture is always that area. I mean, you know, Australia's a great tourism spot as well. I think that's an opportunity. But look, as I said, I think this will blow over pretty quickly myself, and we will then see the bull market continue again. And while interest rates are low, I mean, let's face it, where are you going to park your money, really? So, the only alternative here is really stocks, and the yielding stocks that we've got, and our banks are still in pretty good shape. The housing market has pulled back a little bit, but that's still holding up pretty well. And so, I'm not overly pessimistic at all, really, going forward.
Elio, some investors who are holding stocks that could be exposed to the Chinese market, should they be worried?
Well, look, this was a similar discussion as we had back towards the end of last year when the trade wars, really started to heat up. And obviously there was the half glass full argument that, oh, well, if the US is losing out, surely Australia will do well. And in isolated pockets, that may very well actually be the case. But I think from a net sum as an economy perspective, there's no way we could fill a void of a US or a China in terms of demand or even supply for that matter. But, as David touched on, those agriculture stocks, obviously, but they're very much hot at the moment anyway, and they'll probably remain that way. So if anything else, it just ensures it doesn't top out, that there is another possible run up there. But yeah, look for those stocks that do export a lot of their goods overseas, because a weakening Aussie dollar is good for them. And traditionally for our market, a weaker dollar is great. Throw in the low interest rate environment that David mentioned, and we've done significant back testing on this and have found that markets do exceptionally well in low interest rate environments. So there's nothing to suggest that this pullback is going to be the next GFC, for, dare I say it. But
touching wood.
No need to touch wood. That's okay. I'm relatively confident in that call. But I do think, though, that 10 to 20% pullbacks in the market are very healthy. You need that in order to ensure things don't get overheated, because, as David will tell you better than most, if share prices go parabolic, they can go in on themselves, and that's when you get disaster.
Absolutely. In the meantime, we keep our eye on the headlines and hope that some sort of positivity will
especially if you're buying stocks like Lyft or Uber.
Well, that's rampant speculation. Deserve to lose money.
We are going to take your calls and your emails for the next 2 hours or so. So you want to call into 1300 30 34 35. You can email us your call at yourmoney.com.au. I believe Vivian is on the line from Sydney. Your question for the panel, Vivian.
Yeah, hi. I'm just inquiring regarding the company Unity Wireless. I bought it 2-3 weeks ago, and I'm up 150% on it already. So what do I do? Keep it, sell it? Do you know anything about this company? I believe the CEO used to be the CEO of M2 a few years ago, MTU. Maybe you can help me? Thank you.
Thank you very much, Vivian, for your question. Elio, is Unity Wireless a company that you're familiar with?
No, it's not. It's only newly listed, a new ADSL provider in a highly competitive space, but obviously its share price has done well on that. That's, by definition, the example of a stag profit, if there ever was one. And I think, Vivian, you just need to put your common sense hat on and just think about where it's come from, where it's gone to, and in the incredibly short amount of time that it's done it. These things, when they go in that straight direction, tend to form what we call a Mount Fuji pattern, which is basically right up and then right back down again. And I'm not suggesting that will necessarily happen with this, but obviously the speed of this rise in such a short amount of time in what has to be a very competitive space, which is still trying to find itself its own sure footing on the back of the ACCC's recent decision around Vodafone and TPG. I think you'd be looking to take some of the profits off the table here, to be honest.
Okay. David, what do you make of Unity Wireless?
Oh, look, it's the very same comments as Elio. It's just like, if you made 150% in a couple of weeks or few weeks, then take some money off the table.
Got to be pragmatic.
Yeah, you have to be. So, yeah, look, they don't have enough earnings in record as far as I'm concerned, and it's just been a straight move up here, and to me it looks a bit overdone. So, yeah, I can't really add more to that.
All right. Okay. Vivian, thank you very much for your call. We want to take a little bit of a step back and bring in Scott Phillips now from the Motley Fool, who I think has sorted out his technical issues. He joins us now via Skype. Always great having you here to join us, join our conversation, Scott. We were talking a little bit earlier on about this trade war. What's happening with it? Where is it going? Should we really be concerned about it? Of course, as I made mention, it is the gold stocks that has really benefited from this safe haven assets, of course. Gold stocks on the way up. But is this a question of until there's a resolution or until the next good headline?
Fauzia, gents, good afternoon. So much in that great question, Fauzia. The reality, I mean, gold is considered a safe haven. I think it's probably the worst designation on the stock market, although there's plenty of competitors for that title. If you look at the return of gold over any long-term period, it's been abysmal. And so I've got to say, if you're a trader, maybe you can make some money on the way up, the way down, as David was talking about. But gee, it's tough. I mean, even if you get that safe haven benefit in the bad times, they come so infrequently and so unpredictably that if you hold gold for any length of time, you are literally going to get your backside handed to you. It's just an awful play. As you say, that's exactly what's happening on the market today, because that is the general view on the market. And you're right to say that many investors, many commentators, traders see it as a safe haven asset. So it absolutely is doing well. I will take David's point. He said the only surprise was the market was up on Friday. I'll go a step further and say the only surprise is the market's been up so high for the last couple of months. Now, look, I'm a long-term investor, so I'm all about the long term. I don't really care what happens with the trade talks from a long-term perspective, other than the extent to which it gives us some opportunity to buy some stuff cheap if shares do fall. But the reality is that the market had priced in absolute optimism on the Trump-Xi trade deal, which, if you say that slowly, optimism on a deal that was going to be done at some future point between Donald Trump and President Xi without any possible ramifications, further negotiations. It was just, the market was a little bit nuts, quite frankly, to have priced in all the optimism and priced in none of the pessimism. The fact that Trump and Xi were going to let this kind of just slowly go to its conclusion, everyone's going to shake hands, pose for the photos and walk away, was just so unlikely as to be silly. I've been saying that on your program, Fauzia, and on James's program on Monday afternoons for weeks and weeks. The only surprise is the market was surprised by the fact this has happened. So, look, it's going to happen. Bond markets are supposed to be and are going to be volatile, so you should expect that. The long-term story, I think, frankly, is unchanged. But if you're an investor or if you're a trader, you need to be careful. If you're an investor for the long term, just be thoughtful about how you're positioning yourself. Frankly, don't get freaked out. Don't get worried out of the market. In other words, don't give up and walk away just because of this volatility. This will pass. Everything else will pass. We've seen Brexit. We've seen everything else come and go right back to 87 and before that. This is what markets do. So just take it with a grain of salt. Don't be too exposed to these things. So don't expose yourself to the risk that some sort of bad outcome is going to hurt your portfolio in a permanent way or in a too significant way, particularly if you're relying on income for retirement, for example. Otherwise, simply look through it and say, well, these things happen. These things do pass. Again, the only surprise is the market was surprised.
Scott, it's Elio here. Look, it's interesting, isn't it? I mean, we saw the lead up to the recent ramifications there, and there was optimism around returning back to normal. It wasn't going to be any better than what it was before. It was simply getting us back square. Now, just like watching Empire Strikes Back in 1980, you left the theatre disappointed, but you knew there was going to be another episode, and inevitably that was going to be good. Do you think the market might very well cotton onto that? I think there was another tweet today saying that in about a month or two that this could finally come to an end, or do you think now we are going to be in for a protracted sideways movement, which is a view that we've had at Lincoln Indicators for some time?
Elio, I'm not sure if the Empire Strikes Back is the next one. Then at some point, either Donald Trump or President Xi is going to be revealed as the other one's father, which is all very confusing with Return of the Jedi. If that's the next episode, I think as you say, this is sorry, mate.
I said, who's Jabba the Hutt then?
You can answer that one, mate. You're braver than me, although the hairstyle. Anyway, let's move on. Look, I think the market should expect ongoing tensions on this one. Now, the thing is, again, because there have been ever-present tensions, ever-present risks about something or other, the latest headline, it wasn't that long ago that China hard landing was the headline. Before that, it was Brexit. Since then, it was Brexit. Yeah. There's always a headline. There's always a key risk, right? And the market just rolls through. To your point, I think probably you and I accepted it, and I'm sure David as well, but the market as a whole tends to forget history so incredibly quickly. It has this sort of bizarre short-term amnesia where 3 months later it forgets what it was worried about last time, and all of a sudden the new threat is the omnipresent kind of, big risk threat that everyone's been waiting for, and then next month it'll be something else. So I'm not too worried about, frankly, the changes that might happen in the market. There will be more volatility, I'm sure of that. Whether the market's go sideways, mate, I have no view. I don't try and predict those things. I will say that I expect that, you know, company earnings should continue to underpin over time, and I think you'll agree with me that value tends to drive share price over the long term. Where it goes in the short term and the medium term, I have no idea. I'm just going to keep investing when good opportunities are presented. And frankly, as Fauzi asked you at the beginning of the program, asked you both at the beginning of the program, you know, does this provide a buying opportunity? I think the answer is obviously yes. If you like something yesterday, and the market's down 1.5% today, then you want to like it at least 1.5% more today. And if you get some that are down even further, then look, you're not going to not buy something yesterday 2% higher and all of a sudden be clamoring to buy it today at 2% lower. By the same token, if you were happy to buy it or hold it yesterday, then you should be happier today if you get a chance to add to some shares.
Scott, just interesting, I was reading or listening actually to a fund manager who, quite interesting statistics that he came up with, and about the index fund buying that's been going on here in the US in particular, like, because index funds have been outperforming professional fund managers, which has been interesting.
Not all of them, I might just add.
Not all of them, except for Lincoln.
Thank you very much.
Except for Lincoln, of course.
Yeah, very much.
I'm talking more about the US. Yeah. But good plug for Lincoln, by the way, because they deserve it.
That's true, thank you very much. That's it.
And Motley Fool, of course.
Yeah.
Thank you, David. And Wealthwise.
And Wealthwise, yeah.
Is there a question, David?
Yeah, just the only thing that has me concerned, because all the retail investors in the US have rushed into these index funds, and the weighting is the highest ever, and then you've got margin loans.
Very true.
I mean, anything horrible goes wrong with interest rates or bonds or something, that's the only thing that worries me. They'll be heading for the exits, you know. And you know, I believe in professional fund managers, you know, such as Lincoln Indicators, and you know, but that will outperform over the long term. You know, that's my view, and I'm just saying that's one of the things I was really quite taken when I heard that, you know, the statistical measures there. So anyway, that was just something I just wanted to see what your comments would be. But
Scott, we're just running out of time. We wish we could get your comment for you. Unfortunately, we are running out of time. Thank you so much for joining us, Scott. Scott Phillips there of Motley Fool. Thank you. When we come back, we'll be answering more of your market queries. 1300 30 34 35 is the number to call. Email us your call at yourmoney.com.